Welcome to Finance for World. Get ready, because today we're taking a serious deep dive into the chaotic, interconnected, and honestly, fascinating 2026 global economy. We're pulling together raw data, market reports, and the absolute latest headlines to make sense of what is arguably the most complex macroeconomic environment we have seen in decades. Again, welcome to Finance for World. This explainer is specifically designed to cut right through the noise and give you the absolute core of what you need to know right now. Let's get to it. We're going to organize this using our macro trifecta approach, breaking it down into 5 key areas. First, a fragmented global economy. Second, the energy price shock. Third, the new inflation regime. Fourth, the AI disruption. And finally, number 5, adapting to the new normal. Starting off with part 1. A fragmented global economy, and the end of seamless globalization. Right now, global markets are really being dictated by political policy rather than just pure economics. According to JP Morgan's mid-year outlook, one of the most tangible risks to the global economy today is our absolute dependence on critical materials moving through very narrow, vulnerable physical corridors. We're talking primarily about Taiwan for semiconductors and the Middle East for energy. This kind of reliance creates immense vulnerabilities for global supply chains. Because, when these corridors are threatened, the seamless globalization we've enjoyed over the last few decades effectively just comes to an end.
Okay, let's dive into this. Just look at the sheer volume of macro noise currently hitting the tape across Bloomberg platforms. We have the recent Trump-Xi summit in China, reportedly bringing some clarity to trade relations. Elon Musk is aiming for a SpaceX IPO pretty soon. We even have local infrastructure disruptions, like the Long Island Railroad strike, just jamming up commutes. And then there are major shifts happening in international legal and business enforcement.
For example, $10 billion. That's the amount Indian billionaire Gautam Adani promised to invest in U.S. projects, and that's a pledge made shortly before the U.S. Justice Department dropped its criminal fraud case against him. Impartially speaking, this resolution, which also involved a $275 million U.S. sanctions settlement with OFAC regarding Iran, really highlights a shifting focus in Washington. The Wall Street Journal notes that this aligns with the new administration's stated mission to resolve certain prior legal matters as its enforcement priorities shift. Moving to Part 2, the energy price shock. Geopolitics driving the pump. When global fragmentation hits those physical choke points we just talked about, it inevitably leads to severe disruptions in the global oil supply. And as you'd guess, that disruption has a hefty price tag. Brent crude recently retreated to roughly $110 a barrel during some incredibly volatile trading sessions. The energy market is just swinging wildly based on geopolitical headlines right now. And that 110 number, that is basically the pulse of the global economy's anxiety. So, the reason for that recent pullback to 110? Well, according to market reports, President Trump paused planned military strikes on Iran. Saudi Arabia, Qatar, and the UAE actually directly appealed to the White House to hold off on military action, stating that serious negotiations were underway. This sparked a huge wave of market optimism that a diplomatic resolution might actually be reachable, which momentarily cooled that spike in oil futures. However, and this is a massive however, despite the pause and the peace talks, the crucial Strait of Hormuz remains effectively closed. JP Morgan actually highlights that this dual blockade represents the largest oil supply shock since World War II. Think about that for a second. We're looking at a persistent daily bottleneck for 20 million barrels of oil. That is roughly 1/5 of global petroleum consumption suddenly just struggling to reach the market. It's huge. Which brings us to Part 3, the new inflation regime. A sticky situation. So what actually happens when the world's energy supply is choked off like this? Well, you can see the tension reflected immediately in the currency markets. The US dollar index recently hovered right around 99. Investors are intensely weighing the likelihood that the Federal Reserve is going to be forced to keep interest rates high just to combat this energy-driven inflation. While recent diplomatic optimism slightly reduced the safe haven demand for the dollar, the underlying inflationary pressure is absolutely keeping the greenback strong. Meanwhile, risk assets are really feeling the squeeze. Bitcoin has been trading near $76,000. Worsening macroeconomic conditions, plus nearly $982 million in fund redemptions just last week, are heavily pressuring investor sentiment in the crypto space. When traditional inflation hedges and safe havens shift around, highly volatile assets like Bitcoin react strongly. And this brilliantly illustrates the historical parallel we are currently facing. JP Morgan's analysts warned that the 2020s could literally replay the 1970s. Back in the 70s, you see, it wasn't just one single event. It was a rapid succession of so-called temporary economic shocks, like the Arab-Israeli war and broad commodity spikes, that eventually just normalized into a high-inflation decade. Now look at our current decade. COVID-19, the Ukraine invasion, tariffs, and now a massive Middle East conflict. We are essentially absorbing back-to-back inflationary catalysts before the previous ones have even fully resolved. This is a crucial point here. Notice how the Fed's preferred metric, core PCE inflation, was already running near 3%. That's well above the target, and that was even before the energy price shock in the Strait of Hormuz began. What this means is that the new energy spike is colliding with an already sticky baseline of inflation in consumer services. The fire was already burning, and geopolitics just poured oil on it, quite literally.
On to part 4, the AI disruption, where opportunity meets volatility.
Now, the economy isn't just one-directional, and artificial intelligence is currently serving as a massive counterbalance to our inflation and fragmentation problems. While energy and fragmentation are pushing prices up, AI is pushing them down. It lowers the cost of expertise and heavily boosts economic output without requiring any additional human labor. In a world constrained by tight labor markets and messy supply chains, AI represents a uniquely powerful disinflationary force. It is basically the ultimate productivity hack for the global economy. And trust me, the market knows it. The capital flowing into AI hardware and foundational models is absolutely relentless. Just look at these headlines. Anthropic is reportedly in talks to raise $30 billion at a staggering $900 billion valuation. AI chipmaker Cerebras Systems saw its stock surge 81% in its trading debut. And top tech executives recently accompanied President Trump on his China trip, which really just underscores how absolutely vital AI infrastructure is to national strategy right now.
But of course, it's not without profound risk. JP Morgan outlines what they call AI maximalist scenarios. And the downside risks here are severe. Will AI hurt the economy by displacing labor too rapidly, causing unemployment to spike? Or will it drag down the stock market by ruthlessly destroying established companies' business models before they even have a chance to adapt? This sort of creative destruction is very real, and it's a question long-term investors genuinely have to grapple with right now.
Let's wrap up with part 5, adapting to the new normal, building portfolio resilience. Now, what's really interesting about this slide is how clearly the data separates the winners from the losers during inflationary periods. So how do we navigate this? Let's bring all these macro themes directly back to your wallet. On the horizontal axis, you have correlation to inflation. Further to the right means the asset tends to go up when inflation goes up. On the vertical axis, you have volatility. Notice exactly where cash and global government bonds sit. They offer almost zero protection against rising prices. Let's break down the specific strategies suggested by JP Morgan's data. Cash and core bonds generally yield negative real returns against sticky inflation. However, real assets act as much better shields. Commodities like oil and metals have a highly positive correlation to inflation, though, yeah, they come with high volatility. U.S. core real estate offers built-in repricing through rent escalators, acting as a great moderate volatility shield. And gold? Gold has surged 130% over the last 3 years alone, serving as a really strong diversifier against both inflation and the geopolitical fragmentation we discussed at the very start. Which leaves us with the ultimate question. Take a hard look at your own portfolio. With the Strait of Hormuz choked off, inflation baselines remaining sticky, and AI threatening to rewrite business models literally overnight, is your long-term investing plan truly built for a fragmented world of volatile inflation? That is the defining question of the 2020s. I hope this explainer has given you the framework you need to start answering it. Keep learning, stay focused, and we'll see you in the next one.